US GDP fell short of expectations last week and PCE inflation data came in flat at 0.3%. All of which has left the market questioning how the Federal Reserve will play interest rates in the month of May. Many have argued that a lower print in GDP demonstrates that the interest rate hiking cycle that we've been on is starting to bite in a meaningful way. So what are we actually getting? Is the data pointing to a soft landing or no landing at all? Hello, I'm Nick Quinn, one of the trading coaches at howtotrade and ForexSignals.com, and this is your weekly preview for Monday, May the 1st, 2023. As the summer months are slowly coming into focus, we kick off May with a packed economic calendar, the sort that can really make a trader's quarter if you plan your campaign of action well. Highlights for the week will be the interest rate decisions from 3 central banks, the Reserve Bank of Australia on Tuesday, the Federal Reserve on Wednesday, and the European Central Bank on Thursday. The Fed and the ECB are expected to hike rates, the RBA is not. Add to this a mix of trade data, PMIs, and US non-farm payrolls on Friday, and you have every reason to be optimistic about the trading opportunities that the market will offer over the next 5 days. So let's dig into the charts and figure out exactly where those opportunities will be. Monday could be a busy session for the Japanese yen. We've already had a no change situation in Japan. Not surprising on the interest rates, but I think a lot of the market was looking for some clarification from the new Bank of Japan Governor Ueda in terms of how they were going to be changing things around. Not a great deal seems to be going on. As a result, you can see Friday's candle there really pushed up to the downside, giving us a lot of yen weakness. Now, where do we go from here? It's a difficult one to really map out, but I think it's going to be a potentially very active market on Monday, particularly given the ISM manufacturing data out in the US later in the session. Now, I just want you to draw your attention. This is the daily chart here. Just draw your attention here to this channel here. That would technically give us a bear flag if we were just touching the top of it here and rotating back to the downside throughout Monday's session into Tuesday. That would open up that as a structural pattern to then trade to the downside past that 130 level all the way back down to 124s. I can't actually see that happening from here, so we've obviously got to then potentially project to the upside what may potentially happen. The blue lines you can see is a beautiful looking harmonic AB equals CD pattern on the yen at the moment on the daily. That gives us, if we stay intact at point C down here around the 130s, it gives us an upside target of 140-ish for our point D, our price reversal zone. From a support and resistance point of view, that brings really into sharp focus this whole area here, all the way up to 142.25, something like that. That is going to be a key important area for us to target. I actually didn't think that we were going to get a meaningful move back to this high here, which was the high from last year, but given the fact that there's no change in policy in Japan, that could certainly be on the cards for the moment. The RBA will kick off the first of 3 interest rate decisions on Tuesday, but we are not expecting any changes down under this week in terms of the 3.6% interest rates that we've got in Australia at the moment. The reason is inflation data in Australia has been rolling off quite nicely to the downside, so therefore I expect a very confident Philip Lowe to be talking during that Asia Pacific session. I suspect that we have got a continuation of Australian dollar weakness from here, as we've seen since that inflation data printed, and if we don't get any change in the dialogue and we're not going to get an interest rate hike, I think we're set to see that continue. You can see it here against the New Zealand dollar. This is a daily time frame. You can see as we're pushing into Friday now, strength in that New Zealand dollar, and the Australian dollar is weakening very, very nicely into the end of the week. It brings a lot of focus down here at the bottom of this leg. If we just take that down to a 4-hour time frame, you'll see exactly what I mean. Really broken to the downside throughout the creation of this channel. No chance of a pullback at the moment, it seems. So I suspect that it brings a lot of focus into this area at the bottom. Personally, as a team, I think we prefer it a little bit lower than this traditional classic support area of 106.85. Potentially, maybe a move back down to the 104, the 106.50s, something like that. Might be a slightly shrewder move before we get a meaningful bounce, but no question, more Australian Canadian dollar weakness should continue throughout the next few weeks. Wednesday will be the apex of the week as the Federal Reserve is expected to hike rates in the US 25 basis points to 5.25%. It has been a very difficult year trading the indices markets, that's for sure. There's a lot of clarity required from Jerome Powell this Wednesday. This could potentially be the final rate hike that we get from the Federal Reserve, certainly for the foreseeable. Obviously inflation dependent as we move to the end of the year. And don't forget, the market is still expecting some sort of a rate cut this year as well from the Federal Reserve. So that remains to be seen. And any clarity that we get from that will be baked into the price action of these equity markets. No question about that on Wednesday. If you look at the actual daily chart here of the S&P 500, this white line here shows us where we started the year. And you can see the journey that we've actually been on. That move there represents only a 10% move now in the stock market to the upside, and it's not been a particularly easy market to work with. It's tended to favor short-term plays. I can't see that that's actually going to change this week. I reckon that as we go into Friday past the Federal Reserve, that we will be maintaining a short-term play bias in all of the indices markets. So for me, I've got this area here that I've been had on my chart for a while. This is from February last year. Big picture stuff, deep resistance area, which we've probed several times. You can just see we've just gone in there at this 38.2 back at the beginning of February. If we get up here towards the end, the middle of the week and towards the end of next week as well, I suspect that opens the door quite nicely for short-term plays around this 50% area, 4,200 up to 4,250. That sort of an area could be a good potential shorting opportunity, and then from there I would not be looking to be a long-term hold on there. I don't think there's enough clarity around this situation at the moment. On Thursday, the ECB is expected to hike rates by 25 basis points to 3.75% in Europe. You can see the trend that the euro has been on. Really quite a nice, robust, underlying, strong-looking euro you can see in this chart here, all the way from the middle of March this year. Now, we've got hawkish and dovish printed on this chart because it's relatively clear. If we get any hawkish dialogue from Christine Lagarde on Thursday, it should be supportive of the euro. She didn't really want a euro over 110, but we are just pushing at the edges of that now, and that looks set at the moment to continue. Anything that's dovish coming from Christine Lagarde, particularly if there's no meaningful traction on the asset purchase programs that they've still got running across Europe, then that could then obviously just keep us contained under that 110 level. Above this area now, if we do get a continued hawkish tone, there's more in the tank, there's more that we need to do to tackle inflation. Any dialogue in that direction could certainly continue to push the euro higher from here, and that would be my base case in looking for a trading opportunity, looking to join in with this trend. This is our next area that is going to be of interest. This is all the way back in November, late November 2021, this massive resistance area here, which goes from just under 114 all the way down to 112. 112.50 has been a number that I've seen talked about in a lot of online forums, a lot of meaningful economic research. It's certainly an interesting area that we could potentially touch this year. Whether we're going to do that in relatively short order from here, I think remains to be seen. But it's certainly, if we're holding, putting weekly and monthly closes above that 110 area, there's no question that opens up the door for a move up to 112.50 over the summer months. On Friday, we get the printing of the non-farm payroll jobs data from the US. We've still not seen a meaningful impact on the jobs market from all of these interest rate hikes that we've had in the US. Are we going to get it this time? Potentially, that could certainly be the case. Jobs are very, very late to the table in showing their changes, given the interest rate hiking cycle that we've been on and the way that inflation has started to move to the downside. We could get something in line this time around, this Friday. The last time out, we created 236,000 jobs. This time, we are looking for 181,000. If we did get a meaningful move to the the downside in the jobs data, that would certainly bring balance to the GDP readings that we've had out of the US as well. As a result, the US dollar certainly looks like it should be in a reasonable spot to trade to the downside. We'll be looking for a dovish play in that jobs data, which would obviously be a stocks up, dollar down type situation. You can just see here on this 1 hour time frame, we're just holding above this range that we've been in for the last week or so. Is that going to crack? It's highly likely. It depends on what the number is going to be. We are going to get a reading in unemployment data as well. Now, the market is looking for that to tick up a little bit from 3.5% up to 3.6%. That too would bolster a short dollar trade from here. So what I would be looking to do is I'd be looking to basically move lower than this support structure, this structural support area here of 101.09, and then looking to be trading to the downside in short order from there. Once we crack the lows of the middle of April down here at 131, that sort of area, that opens up this move, an extended move to this support area down here at 99.50. No question, this will be a busy trading week. It'll set the tone for the summer months ahead, especially with Washington still to get its act together and the world's central bankers under the microscope as they continue to fight the battle against inflation. Things are going better than the market expected at the start of the year, but never forget, we are only 2 quarters away from a technical recession. If you're interested in developing your trading skills, then our team of coaches at How to Trade will help guide you through the markets every day in our trading room, ensuring a high quality service as we cover all of the key market events for you in our live streams. We're also proudly producing streams covering specific lessons in our new trading academy. So if you want to learn how to trade or you want to know more about the markets, our academy is the perfect place for you to start, and you can access everything that you need from our trading room. So after a lackluster start to Q1, Q2 is starting to shape up very nicely indeed. The old trading adage of sell in May and go away has stood the test of time, but maybe not so much this year. You'd be crazy to leave the table right now. 2023 is finally getting started. Until next week, trade well, and we'll see you in the next live stream.